Well, there's more relief for indebted businesses and consumers as the Reserve Bank cut the repo rate by 100 basis points. This is the third cut since this year for an economy already in recession while battling the impact of the COVID-19 national state of disaster. Governor Lesetja Kganyago also announced that the bank is forecasting an economic contraction of 6.1% compared to the 0.2% announced last month. We are now joined on the line by Ndumiso Hadebe, who is an economist and director at Pax Africana Holdings. Good evening, Ndumiso, and welcome to The Full View. What does this mean for the ordinary consumer before we get into what it means for business?
Good evening, Aldrin. What this means for the ordinary consumer is that if you are a holder of a mortgage bond or a credit card facility or some type of loan, it means that the cost of that debt is now 1 percentage point cheaper. This is particularly important in a time where consumers and workers in certain industries do get retrenched or they do get a cut down from the salaries or the wages that they earn, and as a result, they may find themselves not being able to service their debt obligations. As a consequence of this 1 percentage point or 100 basis point cut, it enables them to have free and available disposable income to either one, pay their debt forward, or two, service other basic necessities and needs that they may need in their household.
And then for business?
For businesses, it's quite important, particularly for the SMME sector and even for large corporates. For the SMME sector, it's particularly important because SMMEs typically have a challenge with cash flow. And whenever SMMEs need to gear or leverage their cash flow to sustain them for a period of 3 months without receiving any sort of income, it makes it very difficult for them to be able to service their short-term and their long-term debt obligations, particularly if, for instance, you have a construction company that has been working on a project that now, as a result of the COVID-19 pandemic and the technical recession, has received delayed payments, or work can no longer continue, and as a result, they can no longer generate the revenue that they need to service their short-term debt obligations. This enables them, one, to have negotiations with their creditors for a payment holiday. Two, it also means that if indeed they do have some kind of cash flow to service their debt obligations, it's now cheaper to do so. As a result, it enhances their bottom line and their forecast for that particular project.
Considering that the impact of COVID-19 as well as the national lockdown that we're currently going through, as well as the suspension of what some would say the economy essentially grinding to a halt, that the after effect of this will be long-lasting. Is this the right response from the South African Reserve Bank? Is it aggressive enough?
Well, there have been a number of interventions when we look at other central banks across the globe. For instance, the Bank of England has taken a move to finance fiscal obligations directly. Now, of course, there are legalities around that, and there are debates around that, whether South Africa's legislation and the South African Reserve Bank Act makes provision for such transactions. But secondly, the South African Reserve Bank also wants to ensure, based on their own articulation, but also looking at their balance sheet, to ensure that because South Africa has a floating exchange rate, that we're able to, number one, absorb shocks such as the COVID-19 pandemic and ratings downgrades. But secondly, we're able to be agile enough that whenever there's a depreciation of the South African rand, that it creates a window of opportunity for South African exporters. So that, in essence, also has an impact in terms of the foreign currency reserves that the South African Reserve Bank is able to have to be able to leverage or inject liquidity into South Africa's money market so that lenders are able to lend more money with reduced capital requirements from borrowers. So in this particular instance, I think it's timed quite well, and they have still left themselves a window of opportunity to still intervene further should the impact of the COVID-19 pandemic continue to be severe.
You've mooted this idea and the debate that's happening around what more the South African Reserve Bank could do. And one of those people who have opined on it is Chris Malikane, the former advisor to the former Minister of Finance. And his argument is that the provision does not completely prohibit the South African Reserve Bank from holding in government bonds. What's your take on this?
Well, certainly that can possibly take place. However, it's also quite important to balance out the issues with respect to what does having a buoyant foreign currency reserve from the South African Reserve Bank perspective have in terms of intervening with the fiscal policy responses that South African government has. In addition to that, it's also important to take into context the economic blockages that South Africa has had, which are structural in nature, and this is well documented. We've seen, for instance, the skills mismatch, for instance, that we have in South Africa's labour market, and that is a more long-term structural issue. So what we need to view this particular intervention, we need to view it from the perspective of coordination and cooperation. Much like riding a bicycle, what does the impact of monetary policy have in enhancing the meaningful response of fiscal policy in this instance? And that really comes, it could be determined from a modeling perspective and really determine what combination of interventions will solicit the best outcomes with respect to employment, increasing wages, and ultimately increasing productivity overall for the economy.
Projection there by the Reserve Bank as well that the economy could contract by at least 6.1%. And if we look back at 2008, the 2008-2009 economic crunch, we were just below 1% in terms of the contraction, and about 800,000 jobs were lost there. What should we expect now with this number that has been forecasted of 6.1% in economic contraction?
It's, Aldrin, it's quite severe. The IMF came out today, even with their data, citing that for their forecast for advanced economies is that there will be a contraction of 5%, and for developing and emerging economies like ours, the contraction will be negative 1%. Now, for South Africa, even in our own modeling, we're modeling a contraction of between 3 and 6%, depending on the severity of the COVID-19 pandemic and the protraction of the lockdown and its consequences on certain industries. This, unfortunately, will have a negative impact on workers, particularly with who operate or work within small businesses in particular. And that is why then the fiscal policy interventions are quite important in this instance. Yes, there will be lots of jobs that are shed, but I think it's a window of opportunity for the South African government to not waste a good crisis and really leverage both fiscal, industrial, and monetary policy instruments to restructure the South African economy, which is oligopolistic in nature, but also to deal with competition issues. As we would know that we were supposed to have the auctioning of, for instance, spectrum in South Africa. This then it changes the texture of the conversation with respect to which players are going to be able to purchase that spectrum, and what does it mean for the restructuring of, for instance, the telecommunications industry. I think it's a window of opportunity that we can leverage to really restructure the economy, that we continue to analyze, that it's not configured in a manner that will increase employment for all.
Do you think that the Reserve Bank is at all too hopeful, looking into its forecast of about 6.1% compared to what the Minister of Finance in the UK, for instance, spoke about? He spoke about they expect the United Kingdom economy to contract at least by 30%.
Well, that analysis is really formed by South Africa's interconnectedness, number one, with supply chains across the globe, and number two, how industries within South Africa operate with one another and how that impacts their productivity. For instance, when we look at the situation in France, where they have a gradual easing of their lockdown, where certain industries are starting to operate prior to certain industries. So, for instance, schooling in France is starting to commence once more, and another sector will start to commence. So it really depends on how the approach to attending the pandemic in a particular region has the impact on that particular economy. And in South Africa, we've seen that based on Professor Karim's analysis last night, that South Africa's interventions have been quite unique. Yes, we do need to conduct more testing. Yes, we've been somewhat indeed decisive with respect to how we're dealing with this. But again, we can only be informed by what the empirical data suggests.
Thank you so much for that. Ndumiso Hadebe, Economist and Director at Pax Africana Holdings. We go to a quick ad break, but before that, it is the weather. And when we come back, it is Francis Hurd